Okay, let's start. Welcome everyone, welcome to this webinar Market Thursday. We are Thursday the 5th of November, right after the election, US election that happened yesterday. Quickly, as usual, we're going to be starting with my CV. I started to work in 2000 as a cash equity trader in Paris, working for Pierre Charon Gestion, then for another asset manager called DTAM. And in 2004, I moved to London. I worked for a small boutique, which was actually at a decent size because at the top we were running 3 billion, called Griffin Capital Management, where I was working for the Western European part on the long-only product and on a long-short product. Then in 2009, I joined Infinity Capital Markets, working as a prop trader. I worked for another firm for 6 months as a prop trader. Some of you probably know this company, and from time to time I blog about this company. For 9 years, I run a long short book with the absolute return mandate, no assets and widget constraint. And in 2014, I started to work as a mentor for another company where I mentored people from all over the world, retail traders. And in 2018, I started my own company doing my own mentoring program. And last year in October 2019, I launched the 4x4 video series. So what are we going to be covering today? Today, as always, we're going to be starting with the situation across asset classes, looking at stocks, credit, commodities, FX, doing a market review and looking at the recent performances and the catalysts. Then we have to be talking about the US elections, talking about what is the most likely scenario now, which is Biden plus a Republican Senate. Then we're going to be quickly discussing the PMI manufacturing and PMI services that we had over the last couple of days or 3 days. And as well talking about the earnings season, and we're going to be finishing with a Q&A session. So a lot to cover. So we try to be looking at what happened and what's going to happen. And obviously US elections are going to be the first few slides that we'll be covering right after the situation across asset classes. So if you look at the performances year to date, for those of you who have been doing the Market Thursday, you can see that I added a new one, which is the Bitcoin. And I know some of you will say, wow, very nice. Some others will say, oh, that's bad. Reality is Bitcoin is now getting bigger and bigger. And I just wanted to include the Bitcoin in this weekly and year-to-date performance. Otherwise, the NASDAQ, we know, has been doing very well year-to-date, almost up 30% as of yesterday. So that means up 30% year-to-date. European indexes have been suffering and have been struggling because Europe has been suffering much more than any other region in terms of COVID, and plus because, Europe has been struggling with no growth for quite a long time on average. Emerging markets have been doing pretty well, from China to the EEM. On the currency side, there is a bit of USD weakening across the board, weakening against the renminbi recently. And if we look at the right-hand side with the commodities, we get the gold that is as a safety to heaven, doing very well, up 25% or plus, and WTI, which is on 40%. Same picture on the week-to-date asset performance, and that's from Wednesday close to Wednesday close. So that is as of yesterday evening after the close in the US. So the equity market have been doing very, very well, but it's fair to say that just before, from the Monday to the Wednesday, the market was pretty weak, so we had a sell-off. So make sure that you look at the 2 weeks picture and not only at a 1 week picture. But overall, the market has been on a risk on mode that was confirmed today with another 1 to 3% up across the indexes. Across the currencies, it has been pretty flat, but there has been 2% move in between on a weekly basis. Bitcoin is up 6%, but actually is up another 10%. So that gives you a 15% as of tonight. And WTI, as we're going to see during when we're going to be looking at technical analysis, is still trading around the 40 level, around this level. On the gold, there is something more interesting that we're going to be discussing. On the index level, you can see that healthcare, XLV, has been doing very, very well. Yesterday, it was at the top of the leaderboard, up 6% almost. Why? Because obviously with Biden leading, that means probably it's going to be easier for healthcare. And you had names like Athena, UNH, that did very, very well. On the other hand, utilities has been struggling a bit, despite yields going lower. But there was the renewables coming down were not helping the sector. But overall, healthcare doing very, very well. Next chart, or next table, we look at the assets, different and other assets. Looking at the bonds first. So week on week, the US 10-year, the US Treasury are flattish, but in reality, they moved 15, 20 bips in between. So we went up to 90 bips on the US 10 years to come back. Now it's 75, 77 bips. So the reflation trade that the market was forecasting, hoping, faded away as of yesterday morning. So the week to date is a bit misleading for the US. For the VIX, same story. The VIX is at 27, between 27 and 30%, but had a spike up to 40% last week. So we came down massively yesterday. That is something as well that we're going to be covering. On the top winners and the top losers, you get a lot of special situation, specific news with Biogen coming with a specific news. NIO is still on fire based on the electric vehicle story, the small Tesla slash China slash calls slash frenzy to buy those names. Lyft has been benefiting from the vote in California, same as Uber. And on the top losers, we had some profit taking on some names and more than profit taking on some as well, names that suffer from earnings. I want to discuss as well the COVID. I'm sorry, just that we are, so as I said last week when I did the US election webinar, you can't be discussing the market without discussing the COVID. So this is the picture for the US, and I'm not trying to put US versus Europe or any part of the world, but the COVID in the US has been, the cases have been going up. Deaths have been going up as well. So this is the bottom chart for the death and the cases, the top chart. And obviously, if you look at Europe, there has been a pickup in Europe, both in cases and death. And here in Europe, we are, half of Europe is in lockdown, and it could become even worse. But I think what is interesting is for the US. US in March was 2 to 3 weeks behind Europe. If you think that it's going to be the same again, US versus Europe, then we could have really cases jumping around Thanksgiving. And Thanksgiving, I know that we have US listeners tonight. Thanksgiving is obviously huge in the US because in the US, people are really traveling around that period. So that is something to watch. More importantly, we have this Thanksgiving retail season coming out, and if the U.S. consumer are under pressure, then that could be an issue for the last 2 months of the year. Sorry for the noise in the background. Quickly as well, from time to time, we look at the Fed balance sheet on the left-hand side. So the Fed balance sheet has been pretty stable over the last couple of months, a small up. So they are only buying around 100 to 120 billion every month. So there was the FOMC meeting tonight. Powell was on the tape and talking to journalists tonight. Pretty vague, not many news. What is still expecting and still want is a fiscal stimulus coming from politicians. But if the fiscal stimulus is not coming, then they might have to do something the same as the ECB will be doing probably around the 10th of December when they're going to be meeting next. So we got a big catalyst in Europe as the ECB has been clearly pointing towards this 10th of December with the big bazooka coming. Every 6 months, there's a big bazooka coming from Europe. And on the right-hand side here, we get the US M2 weekly 4 weeks averages. And as you can see, similar to the balance sheet, obviously, is around end of June, start of July. It has been at the same level, but year on year, it is at a pretty high level. So that's for the picture for the Fed balance sheet. In terms of catalyst, and here I'm looking at what's going to happen next. Obviously, tomorrow we get a lot of noise. We get the NFP coming. So the NFP is always bringing a lot of noise. ADP numbers yesterday were not great, meaning that NFP could be disappointing tomorrow. But for the new joiners, just to make sure that not forget that NFP is a lagging indicator and it's really a lot of noise. So trading on the NFP, I mean, when you're professional, it's not very that interesting. It's a lot of noise. So people, when you start, you think it's going to be very interesting. Reality is it's a number where first there could be a lot of volatility and there is a huge uncertainty. Sorry. So that means relying on this number to trade is doesn't work. In other words. So what we're going to have as well next week is some numbers, many numbers from China, having a better picture of what is coming out of China. Keeping in mind that China is doing very, very well. Asia overall is doing very well because they are dealing much better with COVID than we are in the other part of the world. And we're going to have as well confidence, University of Michigan, at the end of the week. And as I said before, this US consumer confidence is very important from now in the next 2 months, because we are coming into a super important season for retailers. That means that from now until the end of December, with Thanksgiving and Christmas, it is key for retail traders, for retail overall. And that means this is the time that normally, based on seasonality, they start to make money. And you don't want the US consumer to come under pressure. You don't want to see COVID cases going up or some pressure coming onto the US consumer, because that could be an issue going forward for the US consumption. So earnings. So the earnings season is a bit flattening now. I mean, it's less active than it was before, but still we're going to have another 3 or 4 weeks of earnings coming, less and less. But what I try to do always is find the names that could be interesting for you and for me. So you get some big names tomorrow. You still get CVS, which is a big name. You get Viacom. On Monday, you get McDonald's. I know that some of my mentees get positions here. And if you come across there as well, Thursday, Walt Disney, Cisco, Amat. So some names coming, earnings season. At the end of this call, we're going to be discussing a bit how has been so far 3 earnings season. Let's now move on to the charts, as always. and start with the S&P 500. So the S&P has been doing obviously very well over the last couple sessions, but actually we started to move up from Monday. I don't know if it's on the expectation of anyone winning, but there has been acceleration recently. Now we are coming into the top end of the range. So in 4 days, we went from the bottom to the top of this range very quickly. In terms of resistance, this is a very weak resistance. So we'll see if we get some kind of fading from here. I haven't had time to check the volume yesterday across the board, but that's probably something that you would like to be doing. As you can see, the volumes there have been fading a bit today. If we look at the Nasdaq, this is the same picture. So we are not yet making new highs. So we are making lower highs, but the move is still there. So we'll see how we're going to be reacting in the next few days. Same picture in Europe, where we bounced nicely from the sell-off that we had recently. So here you get the Euro stocks. An interesting chart is the SOX, the Philadelphia semiconductor index, that is making new highs now. So the Philadelphia SOX index has been really a leading indicator. Similar to the Philadelphia SOX index, anything that is tech in China has been making new highs. So you got those leading indicator of the market or the tech that is driving the market and is still moving up. On the currency, so the euro dollar, if you look again, each week I'm doing the same chart and maybe you're bored with that, but that is to give you the long-term picture of the euro dollar. This is where we stand. So this is a very important level on the weekly picture. That is, we are consolidating since the start of August between 116 and 119. And at one stage, obviously, as always, it's going to be moving one way. The DXY, on the contrary, has been breaking this trend that we had since the start of March. So you can argue that the weakening of the dollar here is a bit weakening now. Other currencies versus the renminbi, the Chinese yuan, dollar has been weakening because, you know, by definition, with Biden winning, that's normally should be helping the China interest and Chinese assets. So that has been as well for Mexico, with USD versus the MXN doing pretty well. On the sterling, for those of you who are in the UK, actually sterling is doing pretty okay, but that can be safe for almost any currency versus the dollar. Turkish lira, what is my chart? I will have put yes. So Turkish lira actually is not making new lows, let's put it that way, versus the US dollar. And you can see those 3 candles in a row. That is a kind of, more than a kind, telling you that we might be at the end of this trend. So for those of you who have positioned, as long as you have been short the Turkish lira, obviously that has been pretty good. But there are some signals technically that the trend might be over in the short term. Bitcoin, again, as I told you, and I try to explain to people, I'm still struggling with the counterparty risk, and I find it still hard to trade. But each time I'm saying that, I get many Bitcoin fans telling me that I've never understood anything. Here, I don't want to be talking about that. I just want to be talking at technicals, something that I mentioned around the 21st, 22nd of October. So we had the breakout, and the breakout again was mostly about the story with PayPal saying that they will be accepting payment in crypto. So that means clearly there is broadening of the acceptance of Bitcoin. After currencies, I would like to discuss 10 years bonds. So this is the picture for the US government bond 10 years. So this is the US Treasury, where we had a spike up to 90 bips and plus, based on the idea that we will see a reflation trade on Democrats winning everything. There has been a correction since then. If we look at the steepening of the yield curve, it is coming as well quite a lot. And when there was talk of reflation trade, that was helping some sectors, but clearly the bonds have been, through the 10 years, US 10 years, have been pretty strong. And this is the picture that we have here. Emerging markets are breaking. That is price action. We broke this 46.40, 46.50 big level recently. Let's scroll down into let's scroll into the WTI. So WTI here, this is the not the front end contract, but CL2, the next contract, which is around 38, 39. So this is a bit lower than the 40s that we had before. We had a sell-off last week, and we bounced from this level. What is interesting as a chart is, I think, the gold. So the gold has been breaking this trend that we had recently, and today had a very strong price action. So today, strong price action across those safety assets. What was interesting today is there was a lot of so-called reflation trade in stocks, in gold, in Bitcoin, in safety. And in the meantime, the bonds actually didn't move that much. But gold today, and I know that many of my mentees do have a gold position, and this is why I'm talking about it, is the chart today was very strong. The price action was very, very strong. I want to go down into some chart that I found interesting, or maybe we should do it later. Should we do it now? Yes, I think we should do it now. So some of the names. So that is the SPY versus the S&P versus emerging market. Some of the names are the Trump, but I think we should do it later during the presentation. So let's go back into the presentation and talking about the US election. So what we had, I mean, it's not a done deal yet, but it feels like more like it, is we probably 95% chance plus that we're going to have Biden plus Republican Senate. There is a lot of noise. It feels like Trump and the Trump administration are still not giving up and are probably going to might go for a recount and a long fight. So yesterday morning in the UK, first, it felt like Trump was winning, but as we discussed last week during the webinar, actually because of the non-voters were mostly Democrats, and the longer we were waiting for the results, came good numbers for the Democrats. So that means still we don't have the Democrats winning everything. It's going to be probably again Biden plus a Republican Senate. So here we get the slides, one of the slides that we covered last week, and we try to see how much I was wrong and how much I was right. So last week we looked at the 5 scenarios based on what could have been the outcome. So Biden or Trump, and the Senate being Democratic or Republican, and as well one of probably the worst case scenario, which was a disputed outcome, which is kind of what is happening. But still, it feels, and if you look at the odds with Betfair, and if you look at the odds of the market, it is Biden plus Republican Senate. As I've been saying for quite a long time, for me, this is the best scenario because I want, as an investor, to have not the majority or one of the two parties having everything. And Biden plus Republican Senate for me is something that I like because that means that on one hand, you're not going to have 100% Republican policy, or on the other hand, 100% Democratic policy, which I think is a good thing. But in terms of market, that means, and that was the slide that I used last week, is it's going to be hard to have a stimulus, a fiscal stimulus. So the market has been pushing hard and hard and hard to have this fiscal stimulus for quite a long time. So as you remember, right before the election, there were talks of 2 trillion. We knew that the stimulus was not coming. But now, because of the fight between the Republicans and the Democrats, instead of having 2 trillions, we might have 1 trillion. The market so far has been swallowing this news pretty very well, probably on the back as well of the same view as I have, which is not being giving full mandate to any of the two parties. This scenario that we discussed as well, there was a case, I think it was Goldman Sachs was saying that in the short term, or quite quickly, the S&P could go to 3,700 in case of a Biden victory with a divided Congress. So in terms of potential trades, my view that it was positive for the US dollar. Why? Because it means less printing for fiscal stimulus, because instead of being for 3 to 5 trillion, so 5 trillion will be 25% of the GDP, you might do 1 trillion in the next 3 months, which is 5% of the GDP, and you're going to have the deficit, but it's not going to be as, let's say, destructive for the US dollar. So reality is the US are still running quite a high deficit. You can argue that when you trade FX, this is always relative. This is deficit versus deficit. But still, the US have been running a higher deficit for quite a long time. So in the long run, this is still dollar negative, but not as much as before. Again, we discussed the rates. The market yesterday, rates came down massively. Yields came down massively. Why? Because the reflation trade is not dead, but is suffering a bit. So the reflation trade is saying, by doing a stimulus, by pushing the economy so high on stimulus, we're going to be running high growth and probably higher inflation, meaning that yields should go higher. And now that the case for the high 3 to 5 trillion deficit is not over, but is not as strong as before, lower rates. So that's why I was discussing looking at TLT with a long, with a 155 stop. And as well, I discussed the possibility of higher volatility with a disclaimer telling that not for necessarily for the S&P 500, and we're going to see why later. That was last week. My call was to reduce gross and net exposure, because my philosophy is going into these events with big exposure is never a good idea. Then looking at the yield curve flattening, when the yield curve is flattening, that is negative for banks and for US banks in the case here, because banks are benefiting from the steepening of the yield curve. And actually yesterday was a bad day for the sector and the industry. As well, that means that it's a tech positive. Why? Because we are going to have less chances of regulation picking up. And yesterday, actually, the whole sector was very, very strong. I ran some of our numbers. FANG, which stands for Facebook, Amazon, Apple, Microsoft, and Google, outperformed the S&P by 3% overall yesterday, meaning that we were in the top 5 session over the last 5 years of the performance of those 5 names versus the S&P. So very strong So tech was really strong. And on the contrary, yesterday we had the same. We had the negative cyclical in relative terms. Why? Because that means, again, not this high push for a stimulus is going to be a negative for anything that is cyclical. So let's look at some of the chart. And here I pick a tab that I found on Twitter where we have the stock market returns in different political scenarios since 1945. So in yellow, we got the one with a Democratic president and a split Congress, which is something that we might have. So why I wanted to do that and put that tab is first, do not shoot the messenger here. And I'm not interested in conspiracy theories. I'm not interested in anything like this. And I know that if you look at Twitter, if you look on social media, there's going to be a lot of trading educators that will push for those theories that actually, if you read between the line, that is why, because people like those theories and that sells well. So me, I'm just looking at the facts. This is what has been happening since 1945. Secondly, here, this is not a trading call. So any ideas that I'm bringing here, I just want to put a full disclaimer. This is some ideas. I'm not saying this is trades. This is your portfolio. You do whatever you want. But based on what happened since 1945, Democratic president with split Congress has been returning 13.6%. And then you get obviously the third disclaimer, which is each time we look at the past performance, and this is here at the bottom, that doesn't mean this is no guarantee of future results. So when I put something and people ask me, are you implying that it's going to happen again? I'm not implying anything. I'm just saying this is what happened before. You do whatever you want with it, but I'll bring you the information. And this is part of my process to understand what happened when we were facing the same situation. So Biden plus Republican Senate. Again, this is the euro dollar, same chart that we looked at before. If you believe a bit in technical, it feels like the dollar might be weakening even more. There is a strong consolidation, as I said, between 116 and 119. With currencies, unless you get an exotic currency, the moves are not going to happen overnight. Unless you get the Swissy in 2015, you're not going to have a move of 20%. Still, that is clearly some levels to check and to monitor actively between 116 and 119. But that means overall, and as we have done through many webinars, the dollar might be weakening a bit more, but Biden plus a Republican Senate means that probably the fall is not going to be as quick as feared before. On the TLT, that is again something that we discussed last week. This is the chart since September, November 2019. So you had yields going lower and lower, and I think it's not that I think, but with the reflation trade that is not as strong as before, the risk reward last week for being long the TLT with a stop loss around 155 was okay. We'll see if there is a second wave or third wave of COVID and another weakening of the US economy. Here we get the chart of the 10 versus the 2. As I mentioned again 10 minutes ago, the steepening of the yield curve is not as strong as it was a couple of days. So we went from 75 bips difference between the 10 and the 10 years and the 2 years, now at 60 bips, meaning that, as I said, the banks suffered big on the day of the election. All the banks yesterday were down between 2 and 5%, whereas the overall market was very strong. I want to discuss, as always, volatility, VIX. Why VIX? Because this is easy to explain and easy for people to understand. Here we are looking at the VIX futures historical prices. So in blue, we get the VIX term structure on the 3rd of November, so right before the election on Tuesday. And in black, we get November the 4th, which was yesterday, on the day of the results. As you can see, from 0 to 90 days almost, the whole term structure has been coming down. The rest of the term structure is pretty at the same level. So as always, with events like we had with the elections, very similar to the earnings, you're going to have a jump in the implied volatility that's going to be priced at that time by market participants. Then if nothing really happens, it's coming down. And even if something happens, most of the time, as people are overpaying or overhedging themselves, you will see implied volatility coming down. So that is the VIX structure. Again, next 60 to 90 days, that came down massively. And as the VIX structure has been coming down massively as well over the last couple of days, that means as well that the dealer and the market maker have to adjust their position in terms of gamma, in terms of all the Greeks. And that helped as well for the market to go higher, because you reduce exposure, you reduce your gamma exposure, you reduce your hedging, and that makes the whole equity universe to go up. So most of the moves that we have these days around indexes, ETF, single names are options driven. And again, I've been saying that over and over. If you don't understand implied volatility, if you don't understand options, if you don't understand how markets are more and more driven by the option, that makes the game more and more difficult. Let's jump now into one of the indicators that we had on Monday and Wednesday. So on Monday, we had the PMI manufacturing coming from the market. So for those of you who don't know these indicators, they are leading indicators that are made across the world, asking business through surveys how they feel from 1 month to another, and the threshold is at 50%, meaning below 50% you feel overall not as good as last month, and if it's above 50%, that means you feel better than last month. All those surveys were pretty distorted. As you remember, we discussed that many times between March and July, August. Why? Because the distortion was so massive that it was hard to read into these numbers. Now, as things are stabilizing at low level, but still it is much, much easier. So if you look at this picture, we can see that most of the 60 to 70% of the world GDP are doing better. In green, we can see that Japan is still lagging. But overall, if you look at the global PMI manufacturing that came out a couple of days ago, we are now at 53% versus 52.4% in September. China, again, is doing pretty well, is doing quite more than pretty well, is doing very well versus the rest of the world. So this part of the world, China, Asia, is outperforming the market. But what is interesting, and is not in this chart as well, is we have many emerging markets through the PMI manufacturing, like China, Brazil, and India, that printed a very high number. On top of the PMI manufacturing, if you read the report, so I just gonna read this sentence. The recovery in the global manufacturing sector continued early this quarter, with the level in the PMI for output and new orders among the highest seen over the past 2.5 years. One risk to the goods sector recovery is the sharp increase in new virus cases, which has resulted in activity restriction across Europe. So you don't need to be a genius to know that, again, as I said, COVID cases are going up in Europe. Last time, Europe was leading the US, and that might be an issue for the next couple of months for manufacturing services across the world. If we look now into the ISM manufacturing, which is for the US only, the numbers were really good, both on the headline number at 59% and the new orders, which is the leading indicator, doing very well. I'm not going to go through all the sectors and everything, but those are some of the sectors that were printing nicely and some of the sectors that were struggling. Again, that is for your top-down analysis. That is always helpful. I would like to jump into the PMI services now, where the PMI services from JP Morgan printed a 52.9 versus 52, quite bouncing nicely. Third month in a row, it's going higher. And the economy, the world economy, is in a much better shape than it was a couple of months or 3 months ago. ESM services are not as strong as the ESM manufacturing. We know why. We know that COVID is impacting services the most. And you can see as well that from the ISM services is not as strong as the ISM manufacturing. New orders printed a bit below the headline number as well. And against that, we had some prices, meaning inflation, going higher. For the sector, this is the same thing. You need to look at the report and see which sectors, industries are doing well. Let's jump now into the earnings season, which is, we are still in the middle of the end of the earnings season. I discussed with you a couple of weeks ago this earnings season. So this is so far a very good earnings season, where we have 86% of the companies of the S&P that are beating expectation, which is way, way higher than the 65% that we normally have during the earnings season. So this Q3 earnings season is very strong versus history. And I don't think this is only the case of expectations were low. I don't think the expectations were that low. This is a good earnings season. Now we need to be looking forward and what's going to happen, what might happen in Q4 2020. As you can see, the estimated earnings growth rate for the S&P 500 are down 12.1%, which is more than the 10.2% that we had in Q3. So expectations are low coming into this quarter. Still, what we had so far is a good earnings season. But what is interesting is the next slide that I found on the market here, which is again a good Twitter account, and it's from JP Morgan. And that tells you, so this is the last part that is interesting, the blue here, the blue circle, where companies that have been missing the numbers, missing the expectations, have been badly hit. If you look at the average miss, which is probably around 2% now, during this earnings season, we have been down 3 to 3.5%. So when you miss, you are badly, the price action is really strongly down. We discussed at the start of the earnings season about Fastly, which went down 20% and carried on with another 20%. A couple of days ago, we had Twitter that went down 20%. When companies are missing, they are massively punished. That means in terms of hedging, make sure that you protect yourself from the downside. And actually, when you think and that earnings protection could be expensive over the earnings season, you can see that during this earnings season, actually downside protection might have been cheaper than what you thought. But overall, again, the earnings season, 86% of the S&P 500 companies have been beating. And in Europe, we get the same picture. which is 70% of the stock 600 companies that have been beating expectation. But one of the problems that we are facing is the expectations for 2021. There is very poor visibility so far, meaning that we are still struggling to know. I mean, it's a bit stupid what I say, but the expectations and the numbers coming into 2021, and you can see as well if you have been listening to different earnings calls, the management have been pretty vague on giving outlook. Next week, I'm going to be doing a webinar on, it's not Sunday, that will be Saturday, the 14th, doing the 10 trading mistakes to avoid. So that will be at 1 p.m. London. I hope to see some of you. That's going to be a very interesting one. Quickly, before we take the questions about US elections and other, I would like to go through the education I propose. So the 4x4 video series, that is a comprehensive online video course that I launched last year in October 2019, based on my 20 years experience as a portfolio manager, hedge fund manager, prop trader, and educator. So you're going to have a macro analysis to build your infrastructure for generating ideas across asset classes, with a big part of my background, which is trading stocks. The idea generation will be divided into top-down, bottom-up, special situation, and active trading. Because like me, in what I do, I don't want to get stuck in one strategy that might not be working for a couple of months or more and not be generating any trades. You're going to have 40 plus videos, 30 hours of footage, and more than 50 Excel spreadsheets. Second part of my offer is the mentoring program, which you can be doing after the 4x4 video series, or if you are an experienced trader and you want to have a more custom mentoring program. This is going to be 12 weekly one-on-one online sessions where we're going to be building your infrastructure and learn how to trade in real money, in real time, your money. So this is about dealing and trading your own money with my help, where we're going to be doing the same as we have been doing along those webinars, looking at the big macro picture, looking at how to generate ideas, bottom up, top down, active trading and special situation, trying to literally to be looking at all those strategies. The idea is to consistently generate positive returns by building a balanced portfolio using different asset classes, timeframes, and strategies. And it is dedicated for people who either want to be managing their own money or people who want to have access to the industry by building their track record. So Q&A session now. Probably there's going to be a lot of questions about US election and others. I just wanted to give a bit more time on questions because I think this is probably more interesting. Any questions for anyone, from anyone? Don't be shy. If you don't have any questions, I'm going to do fireworks tonight. Nothing? Question for Balder. Will the next session be for beginners only? No, there's going to be a bit of everything. What I try to do during those webinars is always try to do a bit for everyone. We are all at different steps of our learning curve. And I know sometimes it's frustrating for some of you when I go through a topic that you already know, and for some others it's a struggle, and those people then ask me and send me email and say, look, Greg, you spend literally 3 minutes on the PMI. I don't know what's the PMI. What should I be doing? What could I be doing? So next week, the 10 mistakes, this is based on my experience. I started like most of you. When I started, literally, I did an internship looking at some people selling some product and some sales trader, and I did some mistakes. I learned from that. Then, I had a book, and I was running a long short, and I had a much bigger book. And I try to help based on my experience as a trader, portfolio manager, but as a mentor as well, because many people come to me from the retail world, and I've been struggling, and I try as much as possible to share my experience. Question: how do we go about becoming a part of your mentoring program? Everton, send me an email. What I do for the mentoring program, what I like to have is a Skype call with people that would like to do the mentoring, and we can discuss if there is a fit. I'm in a position that I have enough mentees to choose who I can help, and I hope I can help you. So I'll be very happy to talk to you soon. A question from Jure. Sorry if my pronunciation is horrible. Do you think increasing COVID cases and a new possible lockdown are already priced in by the market? Priced by the market? Look, in January, February this year, we had many people saying, COVID, nobody cares, blah, blah, nobody cares, there is nothing. And then suddenly the market just said, actually we care. And we cared, and we cared. We went down from 3,400 to 2,200. So the thing is, you need to be factual, and the cases are going up. We know that in Europe, maybe you can call Europe a bit more CC than the rest of the world, and we are not dealing with COVID in a good way, but it is affecting massively our economies. Okay, so there are still some hopes that we're going to have in Q1, Q2 a vaccine. Still, it's a long way, and if we have another wave of lockdown, it's going to affect the overall economy. That is for sure. Problem is many things in terms of playing the downside are not offering great upside, actually, because the optionality of doing it's pretty expensive. But still, when we book, when we try to put a position like those ones is trying to think, what is my upside versus my downside? If you look at the big picture, earnings season is better. ISM, PMI, leading indicators are better. I don't think that the Biden Senate is the Republican is a bad thing. And when I say that, I know that I have to be honest, 80% of retail traders are Republicans, okay, are pro-Trump. So each time I say something, when I say, look, Biden plus Republican Senate is not that bad, I know 80% of people that are watching me just hate me. And I know as well why other educators are pushing so hard for Trump, because it helps. But the reality is, I've been saying that for months and months. I think for the market, it works pretty well, okay? It works pretty well. This is not such a bad thing, okay? And if it's not such a bad thing, I have to say it. And I put the facts, which is, if you look over the last 70 years, a Democratic president plus a Republican Senate has been doing pretty well. And I don't care about the end of the world theory. This is just fact. Any other questions? What is my view on UK banking sector? From Robert. So that is far away from the US elections. UK banking sector. So Bank of England today, so increased QE and has been delaying negative yields, negative rates. Negative rates, if we carry on, what they have been saying is we are discussing negative rates. Okay, so when you say we are discussing negative rates, that means it's going to happen. If you look at the correlation in Europe between SX7P, which is the stock 600 banks, and the Bund, das Bund, you will see there is a massive correlation. So when bonds are negative, it's not helping the banks. So the banks are making money on the yield curve, so they want to have a widening of the yield curve. They don't like negative yields, and they don't like, obviously, a bad economy, because that means they are not making money out of their assets. So economy in Europe is pretty bad. If you look at the UK PMI, the UK PMI is not that great. It's okay, but what we have is, it started today, we get the lockdown. So the lockdown started today. Trust me, in London, it is very quiet, and it's going to be very quiet for the next months. So if it's quiet, and we might have as well negative yields, you got one positive, which is Brexit. I think a deal is going to happen because something has to give now. That is the only positive. So to come back to your question, because sometimes I'm talking a bit too much, Robert, what you should be trying to be looking at is trying to put on the same chart the UK 10 years, which is the gilts, versus UK banking sector, and see what you end up with. Be careful with the UK banking sector, for instance, because you might say, oh, I'm going to be putting HSBC. HSBC is mostly towards Asia. But do the correlation, do the yield curve. If you're struggling, you send me an email and maybe I can help you. Question from Everton. Could you recommend any books that really help you to get to the level of expertise? I read a lot, but I read a lot of books. I read the tape, I read blogs, I read newspaper. I know that I should not say that, because this is not very what you should be saying normally. I'm not a big fan of books in finance. I find it extremely boring. I feel like most of the time people are talking about something that actually they are bullshitting people. And so I'm not, send me an email. I might have 2 or 3 books that I like and I can be sharing. But I think what is more important is really learning how to build your portfolio. If you do it, when you put money at work, I remember, when I started to trade, I lost, I think at that time it was 3,000 euro 20 years ago, but it was quick. And when you lose money, you want to learn very quickly. Okay. And I think this is the best experience. The downside, and here I read a red flag, is very often when you start trading, you think, okay, I'm going to be making money. Then I want to have access to education. And in reality, because trading portfolio management is so hard, you're going to be starting managing money. You're going to be losing. And then it's going to take you ages to recover that money and to get access to education. So sometimes you're better off have access to education, pay a bit, okay? And obviously here, unfortunately, I might have a bias because, at the end of the day, I'm selling something down the line. But not only, okay, my conviction is to learn, you need most of the time to be paying for your education. And I'm coming from the French system where actually you pay nothing. Everything is for free. But I'm working a lot with mentees in Asia and in Australia. And those two systems, you pay for education. And throughout their life, they pay, and they know more than 90%, or let's say, because the population is much bigger, but a big part of the rest of the world. No one is interested in the US election anymore. Sam, sorry. Do you think doing option calendar spread will work in this environment using the ISM and NMI? I mean, the option calendar spreads is really something that is fascinating people these days. All those questions about option calendar spreads, and sorry, I don't want to be offended. It's just that the trading options is something big these days. And I know that we have tons of educators pushing for the option trading. I think, trading options is a tough one. To pretend that, you can quickly deal with options and trade them is very misleading. So, and I have to say something. I'm pretty fine sometimes in saying, you know, I'm not smart enough. I'm not saying that I'm not smart enough to be trading option calendar, but be extremely careful on trading things that are too complicated, especially if we don't know the basic first. When taking profits, do you have any rules? For example, if it's 10% of your NAV, then maybe take profits. I think you need to take profits. Something that is true, it's as important to take profit as taking your stop loss. I mean, taking stop loss is really important, but the profit, you're gonna have the profit on your book, the profit on one position, how the market is behaving. Each time you enter a position, I ask my mentee when they enter a position, what is your time frame? What's your upside? What's your downside? So when you enter a trade, and that could be 1 minute, 1 day, 3 months, 6 months, it doesn't matter. You're gonna have your time frame and you're gonna have your target. If it reaches your level over your time frame and there is no other catalyst, you have to take profit. Okay, it's the same as the other way around. I think what is extremely helpful is not the trailing stop loss, but trailing winners. So that means if you have 10%, something that really destroys you as a trader, as a portfolio manager, is when you go from being nicely up to flat to negative. So that means when you're nicely up, let's say you're up 15%, and it goes to 10%, take profit on 2/3 of the position, okay? Because you don't want to end up and losing on that position. A question for Sam: why are all educators pushing option trading? Okay, because 20 years ago, or more, long time ago, there was no regulation on leverage. Okay, so people were getting leverage and saying, okay, what about I buy stocks and I buy Microsoft and I buy CFDs and I'm 100% concentrated on that name and I'm leveraging myself 10 times. Okay, so when Microsoft was moving 10%, your account was gone. But, you know, we had some regulation across the world, and ESMA and some others said, look, guys, we need to limit your leverage. So we limit in Europe to 4 times, and in the US to 2 times. But then, you know, retail brokers and educators are pretty smart and say, oh, look, there is option. And option is nice because, you know, you can be making a lot of money. But when you tell people that you can be making, let's say, I don't know, let's say 100%, okay? You say to people that you can be making 100%. And you get the superheroes of this world, you know, top fund manager, hedge fund manager that are making 15, 20% the year, okay? Or let's say 40% when they have a very good year. That means you are doing something on steroids, okay? So you're making something on steroids. So if you want to be an educator and you're targeting the US market, what you do, you sell options, okay? You sell options because in the US, investors, based on their limited leverage, have to be using options, okay? So if you have $10,000 in the US, your max gross exposure is 20,000 gross exposure. So if you tell people, oh, what about you do some options, you put a $1,000 position premium, and that means overall you're going to be running like a 10,000 delta position. People love it. But the reality is educators, brokers should be putting disclaimer around all those products. If 90% of people are losing money trading stock CFDs, imagine what's going to be with options. Jay, do you expect market volatility or turmoil to last if Trump refused to accept a loss? So I was thinking about it today, and today the market was like, you know, not really moving on any Trump tweeting. So normally each time Trump is tweeting, you get the market that is panicking. Okay, so one way or another. Here today, Trump was saying, you know, recount this thing, it's not going to happen like this. And the market was barely moving, like 2-3 points. So either you think that the market has been moving and think that Biden is running from now the show and we don't care about Trump. Okay, maybe, but still, you still got 2 months left before Biden is going to take the helm. I think, again, over the last couple of days, the move has been many options. Okay, so we had the reduction in implied volatility, meaning, you know, the dealers have been chasing the position. But if in the next couple of days we get confirmation that Trump is going for counting the votes again, and socially we need to see, I mean, socially, I don't know if that's the right word, but we need to see what's going to happen in the US on the ground. I think it's here I'm not saying the implied volatility is mispriced, because implied volatility, again, I've been discussing that over and over and over and over, is pretty high. But the market is strong and not reacting. So to answer your question, Jay, yes, I'm a bit surprised, and I will not be surprised to see the market, you know, reacting at one stage to this to Trump refusing the vote. And I think, you know, this market is more and more reacting at the last minute, and everyone is doing the same as the guy sitting next to him. Sam, sorry for so many questions. No, but why are hedge funds underperforming, but retail traders are making 50 to 100%? Okay, Sam. So I think this is a very good question you're asking, actually. So if you tell people that they can be making 50 to 100%, okay, and they can be losing how much? Between 20 to 35%. So if on one hand you can be making 100%, but you can be losing 30 or 35%, if you divide the 100 by the 35%, that is a ratio to 3 to 1. So that is more or less saying to people, you can be making 15% and losing 5%. So guess what? This is exactly what I've been doing for years, which is, you know, downside 5%, upside 15%. And this is what I tell people you're going to be doing without leverage doing the 4x4 video series. If you start to be using leverage, and here, either you are in Europe, you do have like a bit of leverage and you can deal with it and okay with the risk management, or you say, actually, guys, you should be doing it with options because options are offering leverage, then you can be talking about the 50, 100%. But 50 and 100% means your downside is, again, 35%. If you are in the industry these days and you come and say to investors, so all the investors in the world are telling you, oh, we got so much cash. So they have so much cash, but when you tell them that they could be losing 5%, they say, oh, no, I'm not interested. Okay. So you are supposed to have a mandate where you should be making 50% for them on the upside, but no downside. So reality is everyone is doing the same. It's the mandate between 0 and 15%. For retail traders making 50 and 100%, that makes me smile. Why? Because on one hand, we get the facts telling us that 90% of retail traders are losing money. And on the other hand, people or some people are selling, oh, with me, you're going to be making 50 to 100%. And I'm like, okay, what? I mean, yeah, okay. Look, I think Sam, probably you understand what I'm saying here. It's just, I mean, in English, it's probably called bullshit. What else? Which question do I have? I think this is it. Yes. I mean, a question from Rika. At these VIX, do you still have a long short portfolio? Yes. I mean, if you got a long short portfolio, what you're trying to do is generate alpha. So you generate alpha on versus the market, versus the sector, versus the industry, or across industry, or intra-sector, or intra-industry. So yes, building there is implied volatility and realized volatility. So realized volatility is much lower than implied volatility. Okay, so yes, what I said last week is coming into the election is not necessarily the best idea to come into the election with a lot of exposure. I'm pretty sure that over the next 2 weeks, we're going to have people telling us that it was fine and they made a fortune. But building a portfolio here, yes, I mean, it's always possible, and you should be able to do it. Thank you, Kevin. With the Biden rule, do you think defensive stocks will perform better? What do you mean with the Biden rule? So I'm a bit of an idiot, but defensive stocks I've been struggling a bit. Okay, if you look at the slide that we discussed before, tech stocks should be doing better. Why? Many reasons is there are no growth in the world, so tech companies are going to be doing better. And secondly, with the situation that we have now, we're probably going for a standstill, and we are not going to be breaking all those big corporates. So that's going to be benefiting the overall sector. Plus, the no reflation trade, by definition, is growth positive versus value. So growth has been outperforming value for quite a long time. And if there is no reflation or steepening of the yield curve, that is positive for the sector. Thank you, Kevin. That's all for tonight. I hope it helped a bit. I don't know about that question. I don't want to answer that question, Joshua. I'm not interested, but you know what I think. Thank you, everyone. So I might do Market Thursday next Thursday if I'm not too lazy. But otherwise, for sure, Saturday, I'm going to have the 10 mistakes to avoid in trading. If you could join, that'd be nice. You can hear the fireworks in the background. So the UK is still alive. Thank you, all of you, and see you soon. Bye-bye.